time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Let's get to our first Your Stock, Our Take. That is on Enghouse Systems Limited, symbol ENGH on the TSX. Trades around $42.68, $2.3 billion market cap. This was recommended to our small cap Canadian growth stock clients in February of 2011 at $4.17. Stock is up roughly 950%, including dividends over that time. So what does the stock do? Enghouse serves a number of distinct vertical markets through two basic divisions. Their interactive management group division sells a suite of software to manage contact centers, while their asset management group business provides solutions to networks and transit management. Let's look at their fiscal year 2022. Revenues declined to $427 million roughly from 467 million in the same period of the prior year. Negatively impacting the company were its video revenue, which was post-COVID, where it got a bump. There was also a $15.7 million unfavorable FX or foreign exchange charge for the year. There was a growing shift from on-premise to SaaS solutions. The company in the past had been more on-premise, are moving to SaaS as well. So there is an opportunity as well as a threat there. Operating income was $129.7 million compared to $155.2 in the prior year. Net income actually increased to $94.5 million, up from $92.8. That is a result of lower non-operating expenses and taxes in the year. Now, Enghouse has been a Canadian software success story for several decades now. The company knows how to grow profitably via strategic acquisition from cash flow. Management has completed 51 acquisitions since 2002, which has helped to expand the company's revenue basically more than 29 times, from 14 million in 2002 to over 428 million in the fiscal year ending 2022. So we did see through 2020 to 2022, it was a difficult time for Enghouse to execute its growth by acquisition strategy. The enterprise software market, which the company has been acquisitive in, had been bid up to historic multiples. And Enghouse, which is takes a very disciplined approach and fundamental approach to acquisitions, was really unable to find value in its traditional pool of candidate companies at this time. As such, growth declined. Broadly in 2022, the shift to an environment that has a turbulent global economic environment. We saw rising interest rates, high inflation. That led to the valuation declines. This environment now has become more fruitful for Enghouse once again. They're not seeing like absolute bargain basement prices, but they're seeing better prices. Enghouse itself has $228 million of cash in the bank, no debt essentially. We expect 80 to 100 million of free cash flow in the next 12 months. The company has started really to deploy this capital more in earnest in 2023. Number one, it made an acquisition of another publicly traded company, symbol QUMU on the NASDAQ. It's an $18 million US acquisition. The company is a provider of cloud-based enterprise video technology. At the time, that company had revenues of around 20 million US, so under one-time sales they bought it for. They acquired number two, Mobi, which is essentially called Navita. It's a provider of SaaS-based enterprise mobility management solutions. They bought the company for $7.5 million. There were no other terms disclosed. We expect more on that when they release their next quarterly results. So near term, we'd expect, because they've just started to deploy that capital, growth will be challenged. Year over year declines in terms of revenue in the next quarter, around 10% we're expecting. But that is getting better from what we saw in the previous quarter. It's trading at about 15.7 times forward EBITDA, which is below its acquisitive Canadian enterprise software group peers, which are in the 19.5 to 20 times range right now. And it's below this company, Enghouse's historic average, which is about 16.3. Given the negative growth in the near term, if we apply a multiple of 6, the fair value is about $42 to $44. That is near term until they start growing again. So that's about where the shares are trading right now. as such, we are recommending a hold right now. We're awaiting more growth acquisition catalysts before we buy once again. The stock has done tremendously well over the long term. It's paid significant dividends over that period as well. Great share price appreciation, but in the near term, we think is closer to fair value right now.
Yeah, it's one of those stories. I mean, I remember way back when you were originally recommending it. It had a huge cash balance, and it wasn't deploying it at first. And analysts were angry at the company, like they were on the conference call criticizing the CEO and saying, like, you have this huge cash balance, you're not deploying it. And his response was like, well, we're not going to deploy it unless we find something that's appropriately priced that we actually want to buy that's going to be accretive. So the analysts didn't like that, right? They wanted to see that cash put to work. Then eventually it was put to work, and there was this multi-year period where the stock just absolutely exploded for several years, and it went great. They did all these acquisitions. They produced more cash flow. They did more acquisitions. It was fantastic. But you know, it's I think it's not easy from the perspective of a CEO or a board to like sit on, you know, to not be more active. But I've seen acquisitions where, you know, companies have been under pressure, do an acquisition, they do a big acquisition, and it blows up in their face. It can ruin an entire company.
Yeah, you have to be incredibly disciplined. It's very tough when you have stakeholders, analysts, all these telling you to buy with that cash, and you don't see value. That is one of the hardest things to do. And we saw that in 2006, 2007. Valuations for Enghouse in its target market got incredibly high, and they held to their guns, built up cash, and deployed it following the the 2008, 2009 financial crisis. And you know, for about an 8 to 10 year period, tremendous growth. One of the fourth best performing stock over that decade on the Toronto Stock Exchange. Now they've kept some powder dry right now. The cash is built up. You know, like I said, valuations aren't, you know, you're not a kid in a candy store walking around, oh, I'm going to buy everything, but they're certainly far better than they were, you know, a year ago, 2 years ago. And the company is finding some value. So we expect them to try to deploy that. We'll see how their work now converting their customers to a SaaS-based model progresses over the long term, because we think that is where they need to go over the long term. But they want to still offer on-premise solutions for certain customers too as well. And they're able to do that where some of their clients aren't able to do that. So they have an advantage there, but it also is a challenge as they're selling against some customers who have, you know, experienced significant losses. They're cutting prices right now. So, you know, the environment is fluid, but they have been disciplined capital deployers over the long term. And we would expect that going forward. I think there's no rush right now. I think we watch it and see if they can continue to buy and integrate these companies, you know, at one-time sales, and then integrate them and bring their EBITDA margins up to 20, 30%. I mean, that would be the model going forward. If we can see that and start deploying that once again, it would be a company to certainly be more aggressive buying. But right now we're just at hold. So that will take Enghouse.